James, welcome to the show. So obviously we're seeing a lot of reaction in the mega caps to what we're seeing with the Snap news, but how accurately are markets pricing in the whole picture, whether it's inflation lingering or the domino effects that we're seeing in some of these consumer trends that might then trickle down to profit?
Hey, Rochelle, good to chat with you. Well, the challenge right now is that we're in this new chapter of this inflation story. If you'll recall, last year started with whether it's transitory. Turns out it wasn't. Then it became about the Fed at the end of last year and earlier this year, whether or not they would tighten significantly. And they did. And now that all that's priced in. And now what the market is looking at are basically the fundamentals around how inflation affects corporate profitability and consumer demand. And what we're seeing right now is that a lot of tech companies with ad spend, specific impact on retailers, that's basically being filtered in through their stock prices, and that's affecting the broader market. I think the one positive thing to say, if there is anything positive to say, is that it does not feel as if the bottom is falling out of the stock market. What's happening is that investors are looking closely at the numbers that these companies are guiding toward and reporting. And so ultimately what that means is that we might get an overall downward revision of S&P 500 earnings for the rest of this year. But overall, we still expect a strong number there. And so that gives us some hope that, especially if inflation does subside in the second half of this year, that there is still a reason to stay invested in this market.
James, you mentioned the fact that you think inflation will start to subside in the second half of the year. What are we looking at? Are we looking at 6% inflation, 4% inflation? I guess, how quickly do you see inflation starting to pull back?
Yeah, it's a good question, Jana. If you look at some of the forecasts out there, including what consumers expect through surveys, most people expect about 5% average inflation for the rest of this year. And so there's obviously some risks to that. The first risk is that, economists have generally been wrong about this because this is the first time this has happened in about 40 years. And so it can persist for much longer than expected. And the second challenge is the idea that inflation becomes sticky, that it becomes baked into expectations. And once you start that spiral, it's very hard to reverse it. And so that's a lot of what happened back in the late 70s and 80s. So that's really the question. But if you just take a look at the sort of the forecasts of inflation, mathematically speaking, it should start to roll over because you had essentially the big jump in inflation about a year ago. And so in the second half of this year, you should start to see it roll over. Now, how it affects consumer demand and expectations and behavior during that time, that's really the key question. So regardless, we think that those numbers will start to come down. That'll help a bit. But of course, we still need to be cautious because inflation will still run high. Energy costs are still likely to be high. And so it will still affect consumer pocketbooks and the costs associated with inputs for companies.
Obviously, a lot of people are wondering what we're going to see in terms of the likelihood of a recession, depending on how aggressive the Fed is. But how would a recession in this sort of environment, given that this was pandemic fueled, how does that stack up against, say, a traditional recession in terms of how people should be strategizing right now?
Well, it's challenging to say, it's always hard to tell. The distinction we like to draw, though, is that it is very possible, I'm not sure it's likely yet, but it's possible that we do get what we call a technical recession. That is basically 2 quarters of negative growth. We've already had one. We get a revised GDP number later this week. Right now, consensus is that the first quarter shrank by 1.3% on a quarter-over-quarter basis. Right? That type of recession, a technical recession, is very different from what most people consider to be recessions that then drive bear markets, which are kind of these big cataclysmic bubbles, in many cases, which have sort of a systemic effect, like we saw during the global financial crisis, where it wasn't just lofty asset prices. It was that the entire financial system was called into question. And so there were hints of that during the pandemic when there were fears that that would happen again. Of course, it didn't. And so if you take a look at where we are today, yes, valuations were quite lofty coming into the current period, and you've seen those moderate significantly. It's not clear to us just yet that there is some sort of systemic element to it. So from that perspective, it is possible that the current pullback in the market and the current slowdown in the economy is healthy in the sense that, there was money that was deployed too much toward one sector or another, in this particular case, primarily tech over the last 2 years. And for that to be rebalanced over time, that's healthy for the economy and for the markets. And it's also a good time for investors to be repositioning for this next phase of the cycle.
So, James, when investors are repositioning, they're taking a look at some of those names. When you see a drop in Snap, which is off 43% today, Pinterest off 24%, Facebook off another 8.5%, should you be thinking about allocating some money to those names, or is this a sector that you would still avoid at this point?
Yeah, so unfortunately, this becomes a bottom-up stock by stock exercise from that perspective. It becomes about profitability, right? So, there was a discussion in the last segment about whether this is a glimmer of what happened in the late 90s, early 2000s. And from that perspective, if you look at the companies which are high quality in terms of the quality metrics and high profitability, look at the valuations there, some of them are certainly on sale today. But if you look at the overall market, you have a forward PE ratio on the S&P that went from 21 times forward earnings earlier this year, one of the highest in history. And now we're looking at about 16 times, right? So a significant discount from what we saw. Even if those earnings come in a little bit in terms of expectations, you're still looking at quite an attractive market. So valuations do not predict exactly what the market's going to do over the next year or so. You could still see a bit more pain in that regard, but we're getting to a place where, from a long-term perspective, the market is quite attractive.